Hi, everybody. It's Jose Luis Morales with the Jose Luis Morales Show. Today we have episode number 26. We've got a very special guest. His name is Andrew Kiefer. He's a certified public accountant. He works for CBiz out of the Oxnard office. Today he is going to be going over the different tax implications that are related to selling a primary residence, selling an investment property, selling a secondary home, and even vacation rentals. So welcome to the show, Andrew. How are you?
Thank you for having me today, Jose. It's a great day, so I'm looking forward to this.
Yeah, same here. I'm excited about it. So the reason, Andrew, just so you have a little bit of background about the show, the reason I wanted to do this episode is I feel that there's a lot of bad information out there, and I feel that a lot of times people don't think really about the tax implications when it comes time to selling a property. I don't know if you've ever heard the saying "sell high and buy low." I mean, that in theory, that's a great strategy. But one of the things that sometimes people don't factor into that is all the taxes that are being paid when selling a property sometimes. So that's the reason I wanted to do the show, because in theory, that sounds great. But once you factor in the taxes, sometimes it may not make as much sense.
Right, exactly. Yeah, and when you sell high, the government wants their share of it. So
Yeah.
there's ways to work with it. So that's what we're here to talk about.
Absolutely. So let's talk about a primary residence. So if somebody has their primary residence, let's say it's a husband and a wife, if they sell their property, what are the tax laws in regards to that? And what should people know about that as it relates to selling their primary residence?
So for a primary residence, as long as you have lived there 2 of the last 5 years,
Mhm.
the IRS and the state of California allow you to exclude a portion of the gain. For a married couple, that's $500,000 of gain that you don't have to pay tax on. For a single individual, it's $250,000.
Wow. So essentially, this is one of my favorite tax laws. Essentially, if somebody has their primary residence and lives in it for 2 of the last 5 years, for a married couple, they don't have to pay. They can gain up to $500,000 they can actually have a gain of about 500,000 and not have to pay taxes. Let me ask you this: what is considered a gain?
So your gain is what your profit is on the property, basically.
Mm-hmm.
So the way you calculate it is you have your selling price. Then from that, you get to subtract the expenses or the cost of that property to calculate your gain. So your cost of the property would include the purchase price that you originally paid for the property.
Mm-hmm.
You would get to include any improvements that you did to the house. So such as if you remodel a bathroom, remodel a kitchen, add a pool, add a patio, kind of those big things that you might do to a house, those get added to your basis in the property, as well as you can deduct the selling expenses for your house. So, for example, if we sell a house for $1 million and I bought it, say 5 years ago, and I've lived in it my entire 5 years, and I bought it for $500,000, I put a kitchen in for $100,000, I did a bathroom remodel for $50,000, and I've got some selling expenses in there, let's say another $50,000. So I have $1 million selling price. My basis is $700,000 when I add all those up. So my gain is only $300,000. That gain, if I'm married, is under that $500,000 limit that the IRS gives you. So I would not pay any taxes in that situation.
Essentially, great. So essentially, one of the misconceptions that a lot of people have is that it's how much did you purchase it at and how much are you selling it at, and the difference that would be the gain. But the reality is not that. They factor improvements in the sale of the property. Do they also factor depreciation as well too?
No, there's no depreciation on your primary house. It's only
Wow.
on investment or
So that doesn't even exist. The depreciation is only for investment properties, essentially.
Correct. Yeah, not in your primary house.
That's wonderful. Good. And how should somebody be documenting, like, for example, like, let's say that how should somebody be documenting the expenses or the investments that they've made in their primary residence? Let's say that they invest $100,000 into a kitchen. Is there a certain way that somebody should hold on to this, or what would you recommend in that situation?
I'd recommend usually the larger projects, you're hiring a contractor typically. Some of it you might do yourself, but either way, you should save your receipts, invoices, documents, credit card slips, whatever it happens to be, in case you were to get audited and the IRS would want you to prove your basis in that property. You would need to show you purchase escrow when you bought it, and then plus the cost that you put into the property to improve it. So it's always a good thing to hang on to those. Just create a folder, put them away. This type of thing, odds are you'll probably never need it, but when you do need it, you're going to want it.
And then it's probably more likely, like, for example, like that you would need it if you didn't live in the property for 2 out of the last 5 years, or if it's pretty close on the gain. Like, for example, if you bought the property like back in the 90s or something like that, and obviously the property has appreciated in value, then that's when, I mean, if they only have a $200,000 gain, then there's probably not any need for those receipts, right?
There's less of a risk. Yeah, I mean, you don't have to file any of these receipts when you file your tax return. You just report the sale. If you were happen to be audited, you would have to prove this. So yeah, so if you have a larger gain or you're right on that $500,000 limitation, your odds are probably a little higher of being audited than if you only showing a $100,000 gain or a $200,000 gain, where you've got so much cushion still in that exclusion. Your odds of being audited are probably a little smaller.
Great. Now, what happens if somebody doesn't live there for 2 out of the last 5 years in a primary residence? Like, let's say that I buy a house this year and next year I want to sell that property, and I've only resided in the property in that year. But let's say that there actually is a gain. Let's say that the market, for whatever reason, improved $100,000. How is that looked at in terms of taxes?
Yeah. So if you don't live in that house for 2 of the 5 years, you may end up paying taxes on your gain. There are some exclusions that the IRS provides for. One is change in employment. So if you have to move and your job requires you to move far enough away that you have to get a new house, that can qualify for a prorated gain. If they have a change in health conditions, that's another one. And the third one is kind of a generic, what the IRS calls unforeseen circumstances. They don't really define it very well, but there have been requests of the IRS for some of these things. So some things that have passed have been like a natural disaster. If there's been an earthquake, a fire, a hurricane, and you're forced to sell your house, you can still get a portion of your gain exclusion that way. If you've had a death of your partner, you could sell the house for that. Unemployment, divorce. So those are some of what the IRS considers unforeseen circumstances. So in those cases, you might not get the full exclusion, but you might get a portion of it.
Okay. So it's essentially, it's on a case-by-case scenario, essentially, meaning that it may be depending on your specific situation.
Right. Yeah. If you don't live in the house for 2 years, it definitely depends on your specific situation. Why are you selling the house? And can you qualify for one of these exclusions? Yeah.
And when you say prorated, what does that mean? Like when you said that maybe you get prorated taxes, what does that mean for the consumers watching?
So if you had to leave the house for one of these reasons and you were there for 12 months, well, the test is 24. So if you're only there for 12 of the 24, you could exclude maybe 50% of the gain on that. So there still could be some. It's not necessarily an entire exclusion, but it's very facts and circumstances on what is going on in each individual situation.
That's great. Now, I had a client, and I remember an email that I sent you about a client that bought, let's say, $350, invested about $40,000 into the property. He was at $490, and then wanted to sell like at $500. So $500 minus commissions is already less than the $490, and he didn't live there for at least 2 years. If I understood correctly, essentially, if that client invested the $40,000 into the property, his basis would be the higher, and essentially there wouldn't be a gain. So you only pay taxes if there's a gain, essentially.
Correct. Yeah. In that situation, there was a loss, and unfortunately you can't deduct that loss on your personal residence, but there's also no tax to pay. So yeah, so this is only when you're able to sell your house at a gain. At a gain.
Okay. And that gain is based on the basis, essentially. Great. Okay, good. So let's move on to investment properties. So let's say, and this is a perfect transition for that. Let's say that somebody lived in their property for 2 years, and then they rent out the property for another 3 years, or let's say they rent it out for, to the point that, let's say that they rent it out for the next 10 years. What happened? Is that now classified as an investment property, or is that still part of the you lived in the property for 2 out of the last 5 years?
No. So in that situation where you've had a property that you've lived in for 2 years and now you've turned it into a rental, once you pass that 2 of the 5 year test, so basically it's a 5 year window that the IRS looks at. You've got 2 years you've lived in it on your own. You've got 3 years as a rental property to still have this gain exclusion. So if you hold this rental property for 10 years, you're not going to be able to exclude any of the gain on that property. It would be when you sold it, you would be paying tax on that. No exclusions, no nothing. On 100% of the gain, you'd be paying taxes on.
So let me ask you this question. So let's say that it's you lived in the property for 2 out of the 5 years, and then let's say you rented it out for 4 years. No, not. Let's say you lived in the property for 1 out of the last 5 years. Let's say you lived in the property for 1 year, and then the next 4 years you rented out. You lived in the property. Sorry, it's getting confusing, but
yeah,
I think hopefully you get what I'm trying to say. Let's say that you lived in the property for 10 years, and then in the 5-year window, you rent it out for the next 4 years. So it's essentially, how is that looked at? Do you know what I'm trying to say? Or
yeah, I am. It's kind of once you move out of that house, the clock starts ticking. And so it doesn't, as long as you've lived there 2 years before that date, you're good. And then the clock starts ticking the day you move out. If at that point in time, once you move out and turn it into a rental property, you have basically 3 years to sell that house and to still take advantage of the gain exclusion. So if you're renting this property for 4 years, you're outside of that window and you're going to pay taxes on the gain. So the kind of the goal of this, if you're trying to exclude as much gain as possible, is to, yes, move out of the house, and then you want to rent that house for 2 years and 364 days. And on that 365th day, you sell it, and then you'll still be able to take advantage of this exclusion.
Is there any proration on that? Like, let's say somebody's like, oh my God, I lived in this property for 10 years, and now I've had it as a rental for 4 years. Technically, 1 out of the last 5 years, I still lived there, but essentially, I should have sold it before the 3 years. Is there any proration for that 1 out of the last 5 years? Or is it just, if you don't sell within that 3-year mark of turning it into a rental, it's classified as an investment property. Now you have to pay full capital gains.
Right. Yeah. If you miss that 3-year window, now you've turned it into an investment property, because if you're looking at that rental for 4 years, you haven't lived in it the last 2 of the 5 years. And so you would fail those tests. So yeah,
and there's no proration on that. There's no like proration, like 1 out of the last 5 or anything like that.
No, nothing like that. So that's a risk, is if you turn your primary residence into a rental with a goal of selling, you don't know what the market's going to be like 3 years down the road. And you might not be able to sell it at that point in time. Or maybe you have great tenants and this is a great cash flow and it turns into a great rental property for you. But it's something to consider if you're doing this, is that 3-year deadline is a hard deadline.
And this is what I tell my clients, because it's something to take into consideration, because sometimes people do it as a backup option, or they do it on an emotional basis because maybe they didn't get the right price for their property. You have to take a look at what is the marketplace going to be doing over the next 3 years, because that exclusion is big. I mean, you can exclude up to $500,000 for a married couple. But let me give the consumers a quick scenario. So let's say that you rented out the property, or you moved out of the property in 2012, and that 3-year window expires in 2015. Great decision. The marketplace appreciated. You are able to capitalize on some of the appreciation and still get the exclusion, as long as you don't go over that 3-year mark. Let's say you make the same decision back in 2008 or 2007, and it gets to the point where you can't sell it at the price that you wanted to anymore. Now you're forced to hold it on for longer than 3 years. Now, essentially, if you sell it, now the market has depreciated or gone down tremendously. So essentially, when you think about, do I sell my property, or do I sell my primary residence, or do I keep it? A lot of it depends on what are you thinking that the marketplace is going to do, and what does the data show that the marketplace is going to do? Because 2012 and 2008 are completely different scenarios. One of them is a great decision. The other one's a horrible decision, essentially.
Right.
Yeah, so good. Okay, so now let's say that somebody has an investment property. How is that taxed, essentially, if I want to go ahead and sell my investment property?
So if we're looking at selling an investment property, is this a rental property or just one that you bought for an investment?
What would be the difference?
Well, I mean, you can buy a home or a piece of land and just own it without renting it out,
Hmm.
as opposed to using a rental property and generating some income from
So
that.
let's say a rental property, and then we'll go over the different scenarios after that.
Yeah, let me plug in here real quick, get some juice. And yeah, so a rental property, it gets set up for whatever you purchase the house for and whatever improvements that you make again. For when a house is in, now you've got a business, basically. You're renting your house. That's a business. You get to depreciate the property. So that is, the IRS says that for a rental real estate, you get to depreciate that over 27 and a half years. So every year you're taking a little bit of a deduction. It's not cash out of your pocket, but it's the deduction. So it lowers the basis of your property. When you eventually go to sell that property, you will have a gain, and that will be taxed to you. Any depreciation that you take on that property is taxed at one rate. It's called a recapture rate. It's 25% for federal taxes.
Mm.
And then any gain you have on top of that is taxed at capital gains tax rates for federal tax.
Wow. Okay. So essentially, it's a little bit different when selling an investment property. So essentially, they take into consideration the depreciation, and that's taxed at a certain rate, and then the actual gains is taxed at a different rate. Now, is the gains calculated the same way as a primary residence, meaning that what did you purchase at, what improvements did you make, and what are you selling it at minus any fees?
Correct, except the one additional aspect you have for a rental property is depreciation. So what you purchased it at, say it's $300,000, that's going to get reduced over time through depreciation. And so when you go to sell it, your basis might be $250,000 because while you've held this property as a rental, you've been able to deduct depreciation expenses over the years.
Nice. Now, let me ask you this, because like I have clients that are like older clients or like 80 or 90. Unfortunately, I mean, their health isn't that great. They're considering selling an investment property. Or the other option would be to just keep it until unfortunately they pass away and then allow the kids to sell it. What do you think would be better in that situation? Or what would be some of the things that people should take into consideration when selling an investment property in that situation?
Yeah, so for older people, it is a big decision at that point in time because odds are you've held the property for a long time. It's probably appreciated in value. So you could be looking at a substantial gain.
Mm-hmm.
If you were to sell it, you would have to pay taxes on all that gain. You would have less money to pass on to your heirs. If, however, you held on to the property until somebody passed away, that's an unfortunate circumstance, obviously, but the way it works with the tax code is when somebody passes away, the value at the date of death gets stepped up to whatever the fair market value is. And so say you bought a house for $100,000 50 years ago and you're living in it and now it's worth $1 million when you pass away. If you pass that house on to your children after you pass away, they inherit that house for $1 million. So they could turn around the next day, sell it for $1 million and pay no gains or no taxes on the gains because there is no gain. Their basis is $1 million. They sold it for $1 million. So it equals each other. If you were to sell that yourself while you're alive, well, I've got a sales price of $1 million. My basis is $100,000. I'm going to be paying tax on $900,000 of gain there. And so let's just say it's a third off the top of our heads, just for quick calculations. There's $300,000 gone. I'm only able to pass on $700,000 rather than letting my heirs sell the house and get a full $1 million for it.
So this is big. This is huge. Like I've had clients call me and say, "Hey, look, Jose, I want to sell my property. I don't want to leave any problems for my children. I want to just be done with it." And that exact situation where they would have to pay about $300,000 in taxes because they purchased the rental property at $50,000. Now it's worth $1 million. And essentially, whenever I look at this, at least my part is always important to make them aware that there is that step up basis. Now, is there a limit as to how many times somebody can have a step up basis? Like, let's say that somebody has 10 properties. Like, do all 10 properties get stepped up in basis, or is it like only one rental property?
No, it's all properties that you own when you pass away get stepped up in value. The estate tax now allows you to pass on just over $11 million tax-free to your heirs. So as long as your total real estate portfolio is less than $11 million, the value of the properties gets stepped up, you pass it on to your heirs, and there's be no tax implications for you or your estate that you've passed away from or your heirs.
Nice, nice. Now, let me ask you this: like when somebody does a 1031 exchange, and if you haven't watched that part of the show, it was I think episode number 24. I recommend watching it. However, but let's say that somebody keeps deferring the taxes by doing a 1031 exchange, and let's say it's me. I keep deferring the taxes, and let's say I get to 100 years old, which that's my goal, and I pass away. Does that mean that my children now would get the step up in basis on even if I deferred the taxes 100 times?
Yep. Yeah,
Wow.
I mean, that's the ultimate goal for that is you can use 1031 exchanges to consistently defer gain into new properties. And then if you held those properties when you pass away, your heirs get a step up and there'd be no tax on that transaction in your lifetime. And then your heirs wouldn't have to worry about the taxes on inheriting and selling those properties.
So what I would do in this situation is if I'm somebody that is a little bit older and I'm considering selling my property, I would talk to my accountant about that to see what the tax implications are and run an analysis. Be like, okay, look, if you're having to pay $300,000, $400,000 in taxes, I mean, it might be in your best interest to have your children sell it and be able to pass that on to your children as opposed to giving it to Uncle Sam because of that step up basis. So I mean, if you're considering doing that, I would reach out to your accountant and ask them that question.
Yeah, at least be informed of the decision. Sometimes it's an emotional decision. I went through this recently with my grandmother. She decided to sell her house and had to pay some capital gains taxes. I tried to convince her otherwise, but she felt for ease in her situation that's what she wanted to do. I didn't agree with her, but it's grandma. What can you do? So, but at least she was informed of what the tax implications were.
So here's what I realized, Andrew. I don't think a lot of people know about the step-up basis. I don't think a lot of people actually understand that. And
Right.
I think that sometimes your grandma obviously knew both sides of it, but a lot of people don't know both sides of it and then make decisions without actually knowing what the options are. If you're gonna like your grandma, she made whatever decision is best for her, and that's okay. But she knew both sides. So what I want to do is I want to make sure that people understand both sides and then make a decision. And then whatever they decide is perfectly fine. Now we talked about inheritance tax as well too, Andrew. Like let's say that somebody does own a real estate portfolio over $11 million and it's an individual. Obviously they would get up that step up in basis. Is there any tax implications there that somebody should plan for?
Yeah, I mean, if your estate is worth more than $11 million, so your estate is everything that you own when you pass away. So it's your real estate, the cash that you have in your bank account, any investments that you own, any 401ks, all of that stuff gets aggregated together. And if you're over that $11 million limit, and that's a per individual limit, you probably will be looking at estate taxes. So estate taxes are on that portion above $11 million, taxed at 40% rate for federal taxes. So it's something to plan for. And it's something, unfortunately, we see with real estate too. If all of your worth is tied up in real estate and this passes on to your heirs, they're going to have to sell some of those properties in order to get cash to be able to pay those estate taxes.
Yeah, unless you plan for it. But I mean, you said 40%?
Right.
Wow.
40% of the amount over $11 million. So
now, is that for an individual, or is that like if it's me and my wife, it's 11 million and 11 million, or how does that work?
Correct. Yeah, it's per 11 million per individual. So for a married couple, it's about 23 million right now.
Wow. So we're not going to go into like advanced tax strategies on this one, but there's advanced tax strategies for clients that are worth over, married couples that are worth over, or that have assets worth over 22 million. Like, for example, like gifting, and I've heard of other things. Obviously, it's a completely different show, but there is like that, right?
Yeah, there are options if you address it early enough through gifting, working with an estate attorney on how to title your property, how to hold property, where it goes after you pass away, that type of stuff. So there are avenues to explore if that's a situation that you're facing.
So essentially, if you're in that situation, once again, reach out to your accountant, reach out to an estate planning attorney, and start planning for these sorts of things, just so that you have the right information, the right data to be able to make decisions. Good.
Right. And unfortunately, it's something we see a lot of people put off until too late. Mm-hmm. And so it's something, if you know you have a portfolio of real estate or other assets, you own a business, whatever it may be, The sooner you can address this stuff, the easier it is to plan for, to transfer, to take care of this stuff. You don't want to be worrying about this, and you don't want your heirs to be worrying about this either.
Not only that, but it's so important. Like, I feel like having the right team of attorneys, accountants, professionals, financial advisors helping you make decisions is one of the most important things, because I mean, we never know when we're going to pass away. I mean, like, literally, like, people don't plan to pass away. So essentially, the earlier you talk about this kind of stuff and the sooner you get it out in the open, the better you can plan and plan for the unfortunate. You know, I mean, something could happen. I mean, we don't have an expiration date, you know, so.
Yeah, exactly. I mean, I always advise clients, when I see they buy a house or they have children, that's the first time to start thinking about life insurance and having an estate plan in place. Because like you said, you never know, and you don't want your spouse having to deal with this stuff if something should happen.
Yeah, absolutely. Great. So let's move on to like secondary homes or even vacation homes. Is that what you were referring to when you said like an investment property, that you don't collect rental income?
Right. Yeah. So if you have that lake house, that's what I think of as like a second home or an investment property.
Mm-hmm.
On those, there is no gain exclusion on those properties, because you can only have one primary residence for that 2 of 5 year gain exclusion test. So if you have a second home and you were to sell that home, you would be paying capital gains tax on that entire gain that you have. One thing to think about is, do you move into that vacation home to meet that 2 year test? So you'd have to move there, make it your primary residence, actually live out of that house to make it your residence, and then you can start that gain exclusion on that property.
Nice. So essentially, somebody can move into that secondary home for 2 years and essentially then qualify.
Right. Yeah. As long as it hasn't been rented out in the past or anything like that.
If it hasn't been rented out in the past. So if it's been more like a vacation home or secondary property, then there's certain certain things that you can do essentially to avoid paying that capital gains essentially on a secondary property.
Correct. Yeah. If you're willing to move into that house for 2 years and you've never rented it out or anything like that, then yeah, you can take advantage of this gain exclusion, because that's on, all it has to be is your primary house for 2 years. You can only take advantage of that gain exclusion every 2 years. So you can't stack it all up and everything like that. But you could have your primary house that you've lived in for 20 years in a vacation home, go move into that vacation home for 2 years and a day. That now becomes your primary residence, and you can sell that house.
So essentially what I've seen some customers do is they take their primary residence that they lived at for 20 years, they have the vacation home, they sell their primary residence, they take advantage of that tax exclusion law, then they move into their secondary home, they live there for the next 2 years, and then they can take advantage of that law again, right? The 2 out of the last 5 years.
Right. Yeah.
So there's a hint for people.
Yeah.
Now, what happens, and this is a little bit off subject, but what happens if somebody moves into a rental property? Like let's say that they've rented the property out for 20 years and all of a sudden they move into it. Can they qualify for the 2 out of the last 5 years exclusion?
No, not exactly, because that's what the IRS eventually figured out that everybody would want to do. Is you have a rental property that you've had for a long time, you've depreciated the value down, then you move into it and take advantage of these laws. So they have come up with an exclusion for rental properties where a property has been rented out for business purposes. If you then move into it and you qualify for 2 of the last 5 years, you can get a prorated portion of that gain. So let's say you've had this as a rental property for 8 years, you move into it for 2 years. So basically you've lived there 20% of the time. You will be able to exclude 20% of that gain, or 20% of $500,000 of that gain exclusion. So it's not a complete exclusion of the gain, but at least you're still getting a portion of it.
Wow. I actually didn't know that. I had heard of people doing that, moving back into it. And I think that their misunderstanding was that they would be able to take advantage of the 2 out of the last 5 years again. So essentially it would be prorated. Now, let's say let's say the rental was for 5 years and then they move into it for 5 years. Does that mean prorated 50% of the gain?
Right. Yeah. It's what they consider business usage versus non-business usage time, divided by the total amount of time that you've owned the property.
So essentially, if you've had a rental property for 20 years and you move in there for or 10 years and you move in there for 2 years, it would only be 20% essentially.
Right. Yeah. Yeah.
Wow.
Still better than nothing, but you're not going to get the full exclusion.
So essentially, in order to take advantage of that, it would have to get to the point where the time you've resided in the property dramatically exceeds the time that it's been a rental property in order to be able to capitalize on that.
Right. Yeah.
That is great.
Yeah, because the IRS doesn't want you to take advantage of what they consider the appreciation while it was a business asset. So
that is great. That is great. Great. All right. Anything else that you think our listeners would benefit from, Andrew? Anything that we might have missed? Anything that you think that would be helpful to somebody considering selling a primary, an investment, a secondary property, or even a vacation home?
Yeah, I mean, one thing to bring up though is if you do have a taxable gain, it is considered a capital gain. And so that gets lumped in with any other capital gain that you might have or other capital losses. So if you did have a situation where you had a gain on the sale of your primary house, a rental house, whatever it may be, you may look at other assets that you own that are in a loss position and consider selling those, because the gains from the sale of the house can be offset by losses on the sale of stocks, for example. And so that might be a way to help reduce some of the tax impact of the sale and the gain that you're going to have to take.
So
and then there's
say that again. Like, so essentially, if you have like stocks that appreciated in value, or is it the other way around?
Other way around. So if you have a loser stock and you've got this big capital gain event, it might make sense to sell that stock so you can take that loss and offset it with that gain. And so it helps reduce your taxes a little bit. There is a time limitation of when you can go and repurchase that stock, but and it's 31 days is that limit. So it's a way to take advantage of, maybe you've got some stinkers in your portfolio. You have this big gain over here. Maybe you take advantage of those losses rather than, what's the point of keeping those losses? Take advantage of them, wait 31 days, you can get back in that market position. But at least you're putting money in your pocket now by some tax savings.
Yeah, essentially.
Great. The other thing I was going to bring up, like you mentioned before, 1031 exchanges are a great vehicle with investment properties. That doesn't work on a primary house. It has to be an investment property, but that's a good way to defer taxes as well. Yeah,
I agree. I'm a big fan of 1031 exchanges. I don't know if you saw the show, but I interviewed a 1031 exchange last week company, and he says that people just keep exchanging until they die. I forgot what he called it. He called it flop and something, but essentially that's their strategy. They just continue exchanging, continue deferring the taxes, and then once they die, they get that step up in basis.
Right. Yeah. That's the ultimate long-term goal if it works.
Yeah. If you're able to, obviously, if you own the properties, like you don't have partners that are getting divorced or something where you're forced to sell the property, that's something to take into consideration as well too. If you're ever teaming up with somebody and maybe they're in a lawsuit and they are forced to sell something, or maybe they're getting divorced and now you have to sell the asset, there's huge tax implications. So,
right. Yeah. Sometimes you don't have a choice sometimes. So the more you can control, the better off it is. Yeah,
absolutely. Great. Andrew, well, I've enjoyed the show. I think that you provided a lot of valuable information for the listeners out there. Where can people get a hold of you if, for example, maybe they're looking for a new accountant, maybe they're looking for somebody to give them some sort of analysis, or maybe they like the way that you explain things and they want to begin working with you? How can somebody touch base with you?
Yeah, so like I said before, my office is in Oxnard, California. My email address is probably the best way to contact me, and that's akiefer@cbiz.com. So that's AKIEFER @cbiz.com. Or my office line is 805-988-3222.
And just for the listeners out there, what I've enjoyed about Andrew is whenever I ask him questions, he answers me very directly, gives me the information. I had a previous account that when I would ask him questions, they said, "Oh, this is why you need to pay me that $10,000 to come into the office," or "This is why you need to do this." And I just wanted to answer sometimes. So I appreciate that. Not only that, he's extremely, extremely organized as well too. And that's one thing that you do want from your accountant, to be extremely organized. I think that's one of the key qualities. So I appreciate your time, Andrew. Thank you so much for being on the show. And I look forward to continuing to work together and providing value in the community.
Yeah, thank you very much. Take care.
Bye-bye.